Welcome back to another stock market open live stream. Today we have, we're basically on the eve of the Jackson Hole speech by Jay Powell, where we expect monetary policy to get a nice little outline in terms of the intentions of what Powie Wowie thinks might end up happening. We did get unemployment claims this morning. I personally hate unemployment claims because I recognize that historically they're extremely lagging. Usually you only see unemployment claims move to the upside once you're already deep in a recession. They did not move much at all today. In fact, we moved up about 5,000 from the prior release, but matched expectations. And then continuing claims came in slightly lower than expected, 7K lower with a 5K revision down. So no big news there, and markets now excited about potentially pricing in some good old rate cuts. So you've got indices green, Dow up 7, S&P up 20, Nas up 33. You've got oil ticking up a little bit. Brent, your international blend, is sitting at 76.52. Then let's see here. We have gold. Gold down a little bit today, and yields up a little bit today. Yields usually are pretty volatile. They don't go down in a straight line. And 10-year right now is up about 5 bips. Really, I don't exactly see on what. And I think that's just sort of typical daily kind of fluctuations that you get. So you kind of usually, as you trend down, bob up and down as the trend moves down. So the minutes yesterday also were pretty clear about either setting up a 25 BP cut or maybe even a 50, depending on how you wanted to read into that potential for a July cut. But anyway, we've got, let's see, what do we have here? We have the Doomers talking about the minutes, so let's give this a quick little listen here.
Who was a definite hawk. So do we lose one of the votes there and make it more likely that we get a rate cut? That's something we'll have to see after the meeting and see who votes which way.
All right, Mike McKee, it is great to speak with you. It's also great to see that backdrop. It's almost too beautiful to look at. Bloomberg's Mike McKee. We're going to have more Jackson Hole on that gathering in the next hour with former Fed economist Claudia Sahm, of course, of the Sahm rule. And tomorrow we'll have special coverage of Fed Chair Jerome Powell's.
Yeah, I don't know. I'm kind of tired of hearing her. She's like, it's my rule, but, you know, it's broken. Right. Okay, so briefly listen to this guy and we'll hop back over.
It's pretty much a lock at this point that September we're going to get 25 basis points, probably maybe 50 basis points. But what does history tell us about the path of the S&P 500 after the first Fed rate cut?
Yeah, well, first, great to be with you. Going to be an interesting Friday and week ahead. So we've looked at the data, and since 1989. There's been about 6 different cycles, and our work shows a big divergence in the overall market depending on whether the economy avoids recession over the next year or not. So if you avoid recession, which is our base case, on average a year later, the market, the S&P 500, has been up double digits. If you go into a recession, obviously, markets would decline. And I think that's also why the last couple of weeks, you've kind of had this market that's so sensitive to economic data because the divergence in what happens depending on whether the Fed can nail this soft landing or not.
What do you want? Yeah, that's a good point. I mean, basically, you look back and you go, oh, yeah, if we have a soft landing, then we could be like the mid-90s and we can actually run. I mean, the Dow Jones moved really, I think it was almost a double that the Dow Jones moved between 95 and somewhere between 1999 before you got to the dot-com bubble. Which is, 5 years and a double on the Dow. That's freaking awesome. So that's your sort of soft landing style narrative. Now, can we stick that? Well, that is the question we do not have the answer to. But we'll find out because, interestingly, I do like what he's saying when he suggests, hey, that's maybe why markets are a little bit more volatile, essentially, because they're sensitive to, does this increase the odds of a recession or decrease the odds of a recession? Because if it's recessionary, the market's going to plummet. If it's soft landing narrative, the market's going to rally a lot. So kind of an interesting duality here.
V-ish recovery is somewhat surprising. I would say V-shaped recoveries have become actually somewhat more normal over the last couple of years. I think that's based on structure. But I think if you kind of take a step back of what happened, the market started to price in recession risk, and that's why we went down so quickly after that softer jobs number. And as we got data, whether it was from the retailers, whether it's from the initial jobless claims, it took that recession risk out. So I think we're almost back to where we are. I think we are in a bull market. You have to respect the underlying trend, which we still think is high over time. I guess the biggest challenge right now is that now that bar for positive surprises has now lifted again, right after as we move back. But I will say the breadth on this rebound has been very strong. We are seeing some broadening as well. So overall, again, our main point to our clients is stick with the primary trend, which is higher. We still expect that we'll probably see at least one or two more of these kind of corrective periods before year end, but more importantly, stick with that primary trend.
Well, Keith, given that there are those question marks and those concerns out there about basically a recession coming on, of course, the traditional metrics that we all look at, the yield curve, the SOM rule, et cetera, speak to there being a risk of recession. But what's recession proof in the stock market? If you are concerned that we could head into a downturn, where do you go?
Again, not our base case, but if you are more concerned about a downturn than us, then the defensive areas of the market, you're actually starting to see better activity out of areas like staples, healthcare. We are overweight utilities, which tends to do better in a cooling economy. Also has a little bit of an AI play, so we are overweight there. And we also, broadening the conversation beyond the equity side. We've been focused on high quality fixed income. The good news is bonds are acting like bonds again. I mean, I will say after we've moved down, we went overweight duration when the 10-year was around 460. We actually downgraded duration more recently as yields are around 380. So I would say probably more neutral duration, but stick with high quality. And if you're concerned about a recession risk, high quality bonds should still do well on top of some alternative exposure as well.
You are not concerned about a recession. In fact, you expect earnings to continue to grow from here. We had a fantastic Q2, and I know we're expecting a little bit of a drop in Q3 earnings. Here's a chart that Bloomberg Intelligence put together. The last four blocks there representing the last four blocks of 2025, the last 4 quarters, I should say, of 2025. Do you think we're getting a little ahead of ourselves? I mean, looking for 15% earnings acceleration in Q2 and Q4 next year?
Yeah, no, I was just saying, I'm a risk manager, so I'm always worried. I mean, there's always a probability of recession, so we're watching the data, keeping an open mind. But I guess the way I would phrase it is our base case is not recession. Going to the earnings picture, we tend to focus less on the absolute numbers and more on the direction as far as the forward earning estimates, because what happens in between quarters, analyst estimates are always too high, and they always come back down, and then you beat during the quarter as a whole. But I will say, if you look at the S&P 500, we're at 52-week highs on forward earning estimates. Same thing on technology. Where you're not seeing the follow through right now is on small and mid caps. You're seeing those kind of flatline. That's one of the reasons why we remain overweight U.S. large caps.
It's interesting because you have people flocking towards large caps by and large, but at the same time, you've had people all year flocking towards gold, still holding cash. What are gold and cash in this environment? Is that just kind of underpinning here, Keith, the fears under the surface, or are they just good diversifiers?
I think it's the latter. I think it's, for gold as an example, we have a modest position in it. And more recently, even as we've gone risk on, gold has done well. Well, why is that? Well, I think it's two things. Interest rates have come down and the dollar has weakened. So it's a hedge against low interest rates, and it's also a hedge against dollar weakness. There's also central banks around the globe, starting to buy more and more gold. You've seen that from China. So it's also concerns about the fiscal situation we're in, not only in the U.S. and globally. I think cash. We downgraded cash back in April during the pullback in the equity market. I think cash will become less attractive as the Fed starts moving forward. But again, it also provides a little bit of dry powder. So again, you have a lot of cross currents. We're in an election year. There's a lot more stuff to expect as far as cross currents in the market as we move forward. But all in all, diversification still works.
All right, Keith, great to get you on the show today. Thanks so much for joining us. Keith Lerner there of Truist Advisory Services. Another check on futures. We're looking at gains.
Yeah, what's interesting with at the same time, sort of, we've got this guy here saying, hey, base case is not a recession, which is very common. You're hearing that a lot. A lot of odds, by the way, are base case no recession 2024. Odds go up Q1 2025. But what's interesting is, Collins from the Fed She spoke this morning. She might be why yields have ticked up a little bit, because right now markets are pricing in a 29% chance of a 50 basis point cut and a 100% chance of a 25 basis point cut in the September Fed meeting. But she suggested just this morning that the jobs market is healthy despite revisions. That implies going slower, right? Then she literally says a gradual pace of cutting is likely appropriate, which also implies 25 versus larger. And then not seeing a red flag in consumption data, which also implies slower. So all three of those comments that were sort of extracted from her discussion implies 25 BPs or slower for September and on. So worth considering that. You're probably looking at the market having to unprice a 50 basis point cut for September, and then really we just get into how much are we pricing in for future rate cut cycles, and that'll probably be what moves yields. Today you've got, looking again, 10-year right now is up about 5.3 bips. We'll see where that goes. Let's look at the 2-year. We had a little bit more curve steepening yesterday. No, but 2 years also 5.2. Let me go to the 210, and then let's try the, let's see, 20-year moved up about 4.4, and the 30 years up also around that 4 to 5 range. Okay, so the entire curve basically moved up about 4 to 5. If I look at the 210, still inverted by about 15 basis points. So maybe one of these days we'll steepen out of it. But you remember, usually when you steepen out of it, you're knocking on the door of recession. So you don't necessarily want to rush that. Okay, so let's take a peeky at what we've got over here. So let's see, we've got Apple up 50 basis points, so's Tesla. I thought this was interesting. Look at Bitcoin. We got rejected by my 61.7 line, and this rejection occurred yesterday right around market close. That's when Snowflake tanked in earnings despite a slight beat. Then you fell all the way down here very, very briefly to sub 60 again. Broke out of that 67,119 line, failed your breakout to where basically now you're retesting it. Well, I guess I can't say it's a failed breakout yet, but you're retesting that support level. So let's see what happens here with BTC. Just within the last 5 minutes, we started bouncing on that, so we'll watch that. Q's up 47, SPY 32, IWM 10. So Q's outperforming on IWM here. Farmer Brett says, betting there's going to be a recession is fine, but even if we do get a recession, the chances of the market having a substantial sell-off seems rare. Most important thing is buy good stocks. Yeah, I don't know about that. 2008, the Qs were down 55%, and something with a beta of like 1.1, for example, would be down like 60%. Something with a beta of 1.3 at 55 would be down like 70%. So I mean that is Great Recession style. So everybody can trade a lot faster today than people did in the past. Everybody's got a trading computer in their pocket, basically. So I don't know about that. Somebody here donated $21.99 something. Kevin, are you still a bear? Do you think the recent market pull is just a casual bull trap? After yesterday, we see some start to red candles that could lead to more bearishness into AI tech. Yeah, I am still bearish. I'm positioning my portfolio for what I think will be do well in a soft landing or a recession. And there are two sectors that I think really kill it in either soft landing or recession. So I've got some pretty big, like, 7-figure trades on those. Around the margin, I kind of day trade. Sometimes I probably will today. Depends on how I'm feeling. And then as far as also having more of an allocation to cash, I'm interested. A little bit of an allocation to gold. So yeah, I'm like a 2.9 on the bear bull scale. I don't like being a bear. I feel kind of dirty being a dirty bear. But unfortunately, my opinion is that the Fed is going to be late to realizing the damage that they're causing in the labor market. And we're going to get the stuff that we got this morning with Collins, for example, where they're like, oh, even after the jobs revisions, things are still good. We can go slowly. And so I think at first the Fed will move slowly. We're going to get 25, we're going to get 25, we're going to get 25. They don't want to seem like they're dramatically cutting rates right before the election because they don't want to seem political. So to not seem political, they will let politics affect them. And then I think there's a chance that, I don't know, sometimes I'm way too early, but I think there's a chance that by either Christmas or January, we're going to have a little bit more of an aggressive cutting cycle start as really the layoff cycle normalizes. You don't even need the layoff cycle to really spike. You just need it to normalize, because once it normalizes, you will see the unemployment rate move up to an uncomfortable level. So, my take. There's no, not 2.5. It's like 2.9 is kind of where I put myself at. Yeah. Is the bull bear scale out of 10? It is. Yeah. So it's easier to say bull bear, but it's really the bear bull scale. 1 is like dirty bear. You're leveraging to short the market. 10 is perma bull. You're leveraging to go long the market. 5 is balanced. Where you've got some cash, but you're mostly long. You don't really have any downside hedges. 2.9 for me is pretty bearish. 2.9 gets me exposure to like maybe some of my like favorites that I think haven't really run as much yet as some other plays that still have pricing power, even in a recession, like Apple and Amazon. I really still like those even in a recession. And then I'm more interested in some hedging sectors again that I think do well in a soft landing and do well in a recession. Where they get hurt is if the rate cycle is way too slow. So it's not like it's a pure upside. But anyway, yeah, we talk about this kind of stuff pretty regularly in the courses, just because every day we do kind of a course member live stream and kind of talk, positioning ideas or whatever. You're welcome to use coupon code JHOLE and join. 7-figure trades. Yeah. They're both of those sector trades I'm doing. I've got over $1 million in basically options or exposure to those, which I think will be trades over the next 6 months or so, 6 to 12 months. So they're kind of like, I think there are really like 3 types of trades. I think there are sort of your day trades and really short-term swing trades under 90 days. Then there are like your 90 to 1 year plays, which is more like a midterm. I call that more of like the hedging range. And then there's the long term, which is really just like 1 year plus, long-term kind of positioning. Yeah. Take on Carvana, priced with $5 billion in debt. Carvana has done really incredibly. It says, can't believe you actually bought gold. Well, I didn't. I exposed myself to an ETF with gold in it. But Carvana, or gold's done great. Central banks are stocking up. Carvana, it's really incredible. I mean, they just keep running. Even their last earnings, honestly, were good. You had a company that showed that even in this high interest rate environment, they can actually start increasing margin. I was blown away by that. Do these economists really believe what they say? IMO, it's negligent not to talk about the data. Seems Wall Street behind the curve, need to pump before big rug pull. I don't know. Yeah. Higher unemployment was a great sign to cut yesterday. Yeah, I mean, a lot of the revisions you kind of get on like a monthly basis anyway. So you kind of already have this built-in expectation that this was going to be a pretty big cut. So, Jason, that's funny. That is funny. So, which gold ETF? I generally just I have like this for no particular reason, but I just have this like tendency of just picking IAU. It's the reason I like a gold ETF over actual gold is I don't have to store it. It's very, very liquid. I don't have to pay the premium of buying the gold. So you could get options on it. So I know gold buffs don't like hearing that, but whatever. Oh, okay. They literally just put up the stock chart there for a second and then went back to commercial. Okay.
Plus membership plateaued early last year at around 8 million people, and by comparison, Amazon's Prime membership has over 200 million members. And finally, Carlyle Group buying a unit of Advanced Auto Parts for $1.5 billion. The purchase of the WorldPac unit is the first major industrial investment for Carlyle.
Have you seen the Great Taking documentary? No, what's that? Somebody's asking QQQM versus QQQ. Yeah, you should definitely use QQQM. It's the same thing and cheaper. The Great Taking. Not personalized advice, but look at the differences. So, my theory is high debt crisis and high unemployment is intentional, as they know 0% interest would create banking rate and cause bank runs. Everyone knew inflation wasn't transitory and disinflation it doesn't exist when 2% inflation is the constant goal. Okay, it's interesting. Interesting argument. All right, the Great Taking. What is this? Where is it? Oh, I clicked on it and then it went away. How to stop the Great Taking? The Great Taking by David Rogers. What is the book about? Okay, let's read the eBay listing about it. Oh, I can't. There we go. The end game of the globally synchronous debt accumulation supercycle. The scheme is being executed by long-planned intelligent design and audacity and scope, which is difficult for the mind to encompass. Included are all financial assets, bank deposits, stocks, bonds, and hence the underlying property of all public corporations, all inventories, plant, property, equipment. Okay, what's the point? People close to the Fed get to control everything. Author, let's see here, blah, blah, blah. Okay, I guess it doesn't really indicate any kind of bottom line. I guess you got to read the book to get the bottom line on the Great Taking. Interesting. All right. It sounds like the start to like a movie thriller. All right. How are things setting up? Oh, wow. I don't know what kind of setup that is. Sounds like a big barcode there on Microsoft. Zoom's actually trying to go up a little bit. Even Space Mobile doesn't want to figure out which way to go. Snowflake certainly doesn't know what it wants to do. And then what do we got here? Qs are trending, or Snowflake was just trending up going into the open, but down on Tesla, Apple, yields up, knocking some of the mortgage. All right, 1 minute to go here. Let's see what we got. Gall comes in with his $5 asking if I use Head and Shoulders shampoo. I know what you're doing. You're talking about the Head and Shoulders again. All right, let's listen in here.
Before you shoot the messenger of who's doing it, like Wayfair wasn't good furniture either. If it's hard goods, it's just not selling that well. versus, say, soft goods like Gap stores that we're hearing right now. Congratulations to them. Their symbol's now GAP, not GPS anymore.
I saw that this morning when I walked in. I was like, GAP, makes sense. Let's get the opening bell here in the CNBC Real-Time Exchange. To the big board, it is Gap, celebrating its 55th anniversary. And CEO Richard Dixon ringing the bell. At the NASDAQ, it's ALS, United Greater New York. The tri-state area's preeminent ALS nonprofit. You're a fan of these guys down here, though.
Richard, I spent the day with Rich yesterday. We were at the new Banana Republic store in Soho. It was a thing of beauty. He is turning this back to the way we thought it was.
All right, here we go. So let's see what we got. We got Q's popping off a little bit there. Very nice, very nice. We've got what else do we have here? Nice jump there on the Q's. You got the SPYs jumping. You got the jump on Tesla. Nice. Where else? Looks like you've got Apple. Oh, Apple wants to participate. Oh, there comes the red candle. Okay. Let's see here. What else? Q. Which way is it gonna go? Okay. Then you've got Snow 9%. ASTS also slipping here. Slipping and dipping. Then you've got Macy's. Big red there. I don't know what's going on over here. Okay, Microsoft. Oh no, Microsoft wants to go green. Meta's kind of slipping a little bit. Usually Meta likes to go up. Zoom. Whoa. Nice little pop there on Zoom. Wow, look at that. Tesla just tanked. That's interesting. All the way down to that 121 level. And then you've got IWM's negative. Q's now turning slightly negative here. Going into J-hole. People getting nervous about the jack of the hole. What's going on here? You got, that sounds like a bear out there. Oh, yeah, look at that. ASTS really tanking there, down about 4%. Then Target Partey. Let's see here. Target trying to come back. Okay. DJT. Ticking down. That's still up about 2% though. Interesting. Ubiquity's at 181. Enphase kind of losing that 119 line. Nvidia's up one and a bit. Let me put them a little higher here. Let's see Nvidia here. And then what are we doing with Bitcoin? No, you're still above the line here on Bitcoin. So, and Tesla's bouncing at 221. You got like no liquidity on Loan Depot, but looks like it's up a little bit. It's up what UWMC's down. It's your typical first 5 minutes of insanity. And I try not to do anything in the first 5 minutes. It's the first 5 minutes are always crazy. You're gonna cover Powell's speech, of course. So good old Powie Wowie. So he has a speech tomorrow though. So today it's just kind of, you don't really have anything today. You do, just so you know, you do have PMIs coming out. So in about 10 minutes, you're going to get S&P PMIs, and you're looking for manufacturing, services, and composite. You're expecting contractionary on manufacturing and expansionary on services and composite. Composite just averages basically the two together. Not exactly, but roughly. So it's possible you could have some tentativeness waiting for that data, because it is data that could suggest, it's not like huge data, but it is data that people like to trade off of, and then you kind of price in like a little bit more recessionary or a little bit more bullishness. So we usually get to see that. That'll be at 6:45. And so you got about 10 minutes for that data to come out. Okay. So then you've got NVIDIA. NVIDIA wants to kind of keep climbing here very slowly. Carvana slightly red. You've got, what else here? Tesla's just getting stuck at 221. Boy, what a crazy candle at the open there. Then still trying to bounce off 67 there, 60,700. SPY's barcoding, Q's trending down. Micron's trending down. Palantir's trending down. TMF, TLT, everything's down right now. Snow's trending down. Space Mobile trending down. Macy's trending down. Target. Oh no. Oh no, no, no. Not Target. Okay, let's listen in here for a moment.
I remember when he first set up his AI business in Stanford, he knew that he had to seed that to the people who know. A lot of CEOs somehow feel they do know. No, I mean, these are technological marvels. Walmart Plus, that's all run on that. If they can do the same day and come up against Amazon, which I don't think, Amazon's still trying to figure it out.
Although today, Jim, opening in the red, Bed Bath, Best Buy, Target, Dollar Tree, Tapestry, giving back some of yesterday.
Well, I mean, yeah, today's a day where I think people say that we got a little euphoric. Let's go back to the ones that were really light, like Walmart. I just still can't get over that Walmart's so good in China. I mean, everyone's doing poorly in China.
It's funny, I remember visiting a Walmart in China when they first started there. My first documentary. I mean, it was early days in terms of trying to understand the Chinese consumer. It took them quite a while. But to the point you're making, and we mentioned as well yesterday, that sale of the stake in JD.com, almost 10%, which did net them about $3.5 billion or so.
But did you notice the lack of liquidity in China?
Yeah.
That they could do a $3.5 billion block and it could crush the stock?
It crushed
what does that say if
yesterday.
you're like MSCI and you're trying to figure out the weighting of China, right?
Interesting point.
You're Henry Fernandez, unbelievably good CEO at MSCI. Does he look at it and say, wait a second, maybe these prices can't hold up under close scrutiny?
Yeah, no, it's an interesting point, Jim. There is a lack of liquidity to a certain extent. By the way, our own market right now is typically not particularly liquid at this time of year.
Although getting better, and that's been one of the bullish arguments lately, Jim, is that a rise in liquidity is going to be a tailwind for the bulls, even though we're getting some warnings on leverage and treasury futures, people making some big bets on bonds this week.
Well, I have to tell you that in terms of August, I think we all have to recognize, away from the bond market, but the stock market's on fire. I mean, we have all these IPOs, we have lots of news, and
it's
I mean,
a lot of systematic flow. But
yeah, I mean, in 80, you know, if you go back to 87, in the last week of August, you began to get the cracks for the 87 for the crash, where you saw that like Merck would have a bad quarter, the stock would get crushed. We're not seeing any of that now. We're seeing a tight market.
Meantime, equal weight, all-time highs.
Yes.
Mag 7 is on track to underperform for the first time in several quarters
but how
versus
about
the rest
that
of the
piece
market
this morning about Mag 7 that they're underweighted, and then I think the institutions say, well, wait a second, if they're underweighted, let's large cap institutional ownership, mega cap tech under ownership. This is a Morgan Stanley excellent piece that tells you that these stocks are not overweighted anymore. I like this.
Really?
Yeah. I mean,
Not overweighted, really.
yeah, it's pretty amazing. Meta. Oh my, Meta, David, people, they're actually offering an actual return on investment when you spend at Meta. I mean, like, here, this is what you're making. Mark Zuckerberg is a dream come true for any CMO, who then will find their job eliminated because you don't need them anymore.
Yeah.
Mark is your CMO.
Meta has its stock price up 51% this year, far outpacing any name other than NVIDIA.
I got the new Ray-Bans.
Meanwhile,
my wife won't give them to me. They're so great.
Well, dollar index is almost back to 100 and change. Talk about an FX tailwind for this quarter, Jim.
Yeah, I mean, I saw Unilever was upgraded today.
Right.
No, you should be upgrading Procter.
Okay. So what do we have here? I was listening to Jimbo, but you know, the rebalancing of the S&P, it kind of makes sense. You know, it's converging between the equal weight and the market cap weighted. But anyway, Nvidia dropping a little bit now. It seems like there is still nervousness, maybe about the PMIs. That's the only guess I could really have. And the PMIs come out in 5 minutes. So you're 5 minutes away from a catalyst. Obviously, we'll be covering it. Rocket Mortgage going positive here. LDI is nicely positive. Wholesale's catching up. You got Apple sitting around at 34 bips. Tesla's really struggling to keep it up here. Fortunately, that 221 line, that 221 line is pretty good. Obviously no guarantees, but just historically here, it's been pretty good. Let's see here. Okay. Yeah, Bitcoin going for that bounce again. IWM now starting to rise a little bit. SPY sideways, Q's mostly down, Palantir almost at 33 bucks. Honestly, it's pretty good. Yeah, Snowflake, does it bounce at 120? I mean, it had a perfect. Look at that perfect right there on the 1 minute, maybe. I wouldn't be surprised for this to slowly come back to life. This is pretty remarkably, in sort of the low territory. And really what it was is you had a beat, but it just wasn't like an NVIDIA style beat. And I think markets are like, oh, okay, yeah, what? You're investing more in AI? Oh, no. Okay, no, thank you, bye. It's why playing earnings is generally very stupid. Because you could be right on the fundies, just wrong on sentiment. So, and then even if you're right on sentiment, then all of a sudden, you're wrong on the fundies. So I feel like playing earnings has like a 25% chance success rate because you have to get, the direction and then the sentiment and then the magnitude. It's kind of crazy. Whereas, day trading, I think, is closer to like a 60 to 70% success rate when you're following trends. And then, fundamental based could be even larger. So those are just some theories that I have, not necessarily true. But 3 minutes to go for data. AMD still bleeding a little bit here. Revving up 11 bips. That 13 bucks. Honestly, I have to say, I was looking at them from a fundamental POV. I didn't buy them because I think it's a crappy time to buy autos right now. Which is quite the opposite of what I thought 2 years ago. See, in 2022, I thought, if we go into a recession, everybody's going to have so much money and such great jobs, people will still buy their Teslas or whatever else. Well, now it's 2 years later, people are, have less money, and the people that I, didn't think would lose their jobs are starting to lose their jobs, the finance professionals and white-collar workers, and those are your Tesla buyers, so, I'm not too optimistic about that. Hey, Mr. Cooper's up a little bit. Walmart up again, 80 basis points. Wow. That's the company that just keeps on going. Walmart. Amazon back to 180. Wow, nice. It was down there at 160 for a while at the beginning of August and that whole panic. Wow, Trade Desk. I think that's almost an all-time new high at 104. Pretty good. All right, we are very, very close to data. NVIDIA is kind of dropping into the data while Tesla is kind of rising into the data. And Qs are somewhat dropping into it. So, 1 minute to go. All right. All right. So what do we got? BTC, 60,600. We got, what else? Datter. Let's see here. Yeah, Qs keep tripping. IWM, already capping out. It's a little early. Gosh, Tesla's just a mess right now. And ASTS drops again 4.5%. Not the cleanest green day here, that's for sure. All right, who's ready? 35 seconds to go. Is it going to be bullish or is it going to be bearish? I will advise. Again, we are looking for 49.5, which is contractionary on manufacturing. We're looking for 54 on services, 53 in composite. Here we go. We got a miss on manufacturing, a beat on services. It's a little bit of one, a little bit of the other. Composite actually comes in greater. So, I don't know. I actually don't know if that's bullish or bearish. That's like smack dab in the middle. I've literally no idea. Okay. I don't think the market has an idea either. Look at that bar. Let's listen in here for a moment.
Under the 200-day for more than a month.
No, and Benjer's doing a good job. I think that this was directly related to the money laundering case that wrecked the acquisition, David, of First Horizon by TD. Now we know, and it's a gigantic fine. So I think that by a very pristine organization, but Carl's right. I mean, Schwab has underperformed, and it's underperformed because of this sweep issue, whether they're awarding their customers enough money. And Wells Fargo had it. Wells Fargo's kind of breezed.
Wells Fargo, I'm sorry, explain.
They gonna hit the data?
This was all like the sweep, how much you make in your account.
Yes.
And it was a very opaque issue. But remember, Schwab should not be down on this. Schwab is just it's a stock sale. And I happen to think the Bettinger's coming out of it and that we don't want to hark back to that. I think we're fine in that business. The business is good, stock business. It is. They make most of the money from the bank. They use money from the bank.
Yeah.
But I like Schwab stock right here. I would buy it.
It is a busy day today. We've got existing home sales coming up at the top of the hour. But first, some flash PMIs. Let's get to Rick Santelli. Hey, Rick.
Yes, watch the market yields moving up. New highs of the session for 10s. S&P Global PMIs hitting the wires for our August preliminary look. Expecting a number under 50 for the headline, and it delivers. It's weak, 48.0. This is the weakest going back to December, just as the last month at 49.6 was the weakest since December. Now you have back-to-back under 50. All the numbers up to last month and this month had been above 50. So manufacturing not looking so hot. But the service sector is 55.2. 55.2 on the services PMI. This is well better than expected. 55.2 actually is the best only since June. But do keep in mind, this is now the 19th consecutive month above 50. It's a very solid reading. And if we look at the composite, it's also up above 50 for the 19th consecutive month. These are big numbers. 54.1 on the composite, much better than expected, and 54.1 fits in nicely with 54.3. So these numbers on the composite, of course, juiced by services, is giving the market a reason to push higher in rates. And of course, pushing higher in rates is a dual sword. It isn't necessarily what stocks necessarily want to see, but the activity in the service sector should be welcome for expansion with regard to the economy. Squawk on the Street will return after a short break.
Yeah. All right, let's try the Doomers for a moment. Let's see.
Where the adjusted EBITDA forecast from the
company is
Peloton. Almost twice that of consensus estimates. And that's really because they're cutting down on marketing spend and they're really focusing on right-sizing the cost base of the company. And that's really bearing fruit at this point.
You look at this stock over the longer term, Geetha, and it was trading for more than $160 at one point. Okay, that was during the lockdown. Everybody was on the bike. But now it's less than $4. What's your take on the fair value of Peloton in a normal world where we're free to leave our homes?
Yeah, that's a really, really good question, Matt. And I think the problem with Peloton is, despite the results this morning and the solid earnings kind of forecast, the problem with this company, and it's always kind of been the problem, is the lack of sustainable demand. The visibility on the top line is extremely limited. And the company kind of spoke to this, right? They spoke about, not being able to get new subscriber growth. The connected fitness market, while Peloton is obviously the leader in the connected fitness market, has a very, very strong brand. They've kind of tapped out at about 3 million subscribers. And the problem for them is not just not having new subscriber growth. It's that they're actually churning. They're losing their existing subscribers. So in the most recent quarter, they lost 75,000 subscribers. They're guiding to losing over 250,000 subscribers in fiscal, 2025. So, as we kind of look at valuation and you look at this company longer term, I'm not really sure there's a sustainable path when it comes to demand. And so while they would have short-term, a short-term profit bump, maybe even short-term positive free cash flow, as we kind of map out the long-term path, the strategic direction still remains unclear. Remember also, they're still searching for a new CEO. So there are a lot of lingering questions with this company.
Geetha, I find that really surprising because everyone I speak to about Peloton loves their Peloton if they have one and are, adding more things onto it. But of course, an anecdote isn't exactly data. So when you look at that long term, I mean, what's the new CEO to do? Does Peloton try to sell itself? Does it, cut costs even more?
They should use the Precor acquisition and start buying more or building more of that strength training equipment. Back when during the pandemic, I remember they bought Precor. Peloton was like a, multi-tens of billions of dollar company, which is crazy. Now it's like $1 billion company. And they bought Precor for like $450 million or something like that. They basically bought Precor for half of what they're worth today. And back then it was like a massive rounding error. It's crazy. Qs, by the way, are starting to slip. And I was looking at Bitcoin as a little bit of a leading indicator on that while they were yapping here.
There's obviously a lot of different things, but we think, M&A, they have to kind of try and find a buyer ultimately, as an exit strategy for the company.
Geetha, we thank you so very much for your time and all of your analysis. That is Geetha Ranganathan. Now coming up, we're going to talk about the Wall Street beat live from the DNC in Chicago next, with all that money pouring into the Harris campaign. Stick with us. This is Bloomberg.
No, I will not stick with you. I refuse. I'm sorry.
The earliest in the history of that menu item as it rolls out today.
I don't think. The one thing that Brian's going to do is you're going to be able to get in and get out. No matter what, Brian will solve. It's Brian Nickel. He is Mr. Throughput. You should see he cut the time of a Chipotle for 17 seconds in Boston and told everybody, and then they got it to 22 seconds. Nobody is as good at throughput as Brian Nickel. Nobody.
We'll see. It got to flat on the year, currently down about 4%. Stop Trading with Jim's coming up next.
Business.
All the music at CNBC still kind of reminds me of the COVID days. Oh no, not the COVID. Yes, it does. Okay, so BTC stopped falling there for a moment. That's good, because you had things starting to rotate down there a moment. Let's see if it holds here or if it ends up getting rejected. You've got the Qs dropped a bit after that data. Not a major drop, but you've got a little bit, an bit of a downtrend. It's kind of like a curved. Okay, Anyway, Tesla down a little bit. Yeah, BTC trying to break through it. That's bullish. Let's see if it can hold it. And then you've got NVIDIA that's up about 1.2. Q's still working on that recovery. Got to work that out. Yeah, because BTC is trying to send you a nice little bullish signal there. You've got Target now down a little bit more. What else is moving? PayPal tried to move up a little bit. Microsoft, Meta. Ooh, Meta's rallying. That's good. That should drive the Qs up, not down. Yeah, look at that. I'm getting that Q spike in line there with Meta. So let's see what happens there. Then we've got Tesla is pretty much flat at the moment. Yeah, looks like it's trying to come back and gain the lead. So is this bullishness gonna hold? That bullishness looking good. I don't know. It's only been a couple minutes. Usually I like to see a 5-minute trend. But yeah, NVIDIA's pushing up now. And so is Apple. Yeah. Coming back to kind of where that data came out. Let's see here. What is this? Palantir. Ooh, Palantir back over 33. Not bad. Not bad. So, let's see here. All right, what else here? Okay, so then we've got a little bit of a cap out there. Let's see if that what direction this ends up going. It seemed like Meta and Nvidia were still trying to push through though. Let's see them for a moment here. Yeah, look at that. Those are some nice candles there on Meta. Is that going to hold? Let's see here. Let's see. Sort of, yeah, BTC still pushing bullish. That's good for the market to go up. It might be the way it goes today. Let's listen into Jimbo.
Run for Lulu, and I point that out because they report on the 29th. It'll be a very significant quarter.
Are you willing to take what Piper said about EL in China, meaning the bear case is played out, and transfer that to Nike, Lulu?
No, too early. And it's not clear to me at all that Estee Lauder, that the bear case is cleared up. I think that was just someone grasping at straws.
Meantime, tonight?
Okay, I've got a lot tonight. I've got Viking, which didn't have the numbers that I would expect. Not the therapeutics kind, the cruise kind. Okay, David?
Cruises. Yeah.
Then Intuit, which every small business absolutely loves, and Godarzi's so fabulous. And then Fortune Brands, people don't realize these guys are involved with like no mold, shutting your water down, and also high-end stuff. Insurance companies are demanding that you buy their product in order to be able to stop flooding inside their house, and I love that pull. What a nice business they have. By the way, China, horrible for them.
Jim, we'll see you tonight.
Absolutely.
At Money, 6 p.m. Eastern Time. When we come back, Philly Fed's Harker, live from Jackson Hole. Don't go away.
Again over here. Powell speaks tomorrow.
Senate race, in her AG race, in her campaign when she ran for president. And that's kind of an inner circle that's right up to the bat and being considered for those positions.
Amanda, we have to leave it there. Wish we
Possibly.
had
It's very early.
more time. Up against the clock. Stay tuned to Open Interest. We're going to speak more about the DNC next. This is Bloomberg.
Growing your business is easy once you know the moves. With GoDaddy Websites Plus Marketing, you can quickly create a website and AI will customize it for you. Get your business out there and get more customers in here. No sweat. For you anyway. Create a beautiful website.
Okay, boring. Let's see if the Varns has anything for us today. Almost at 7 a.m. here. Let's go to Varney Varns and see what they have. Nothing. More commercials. Everywhere you go, it's commercials today. Just commercials. Let's try over here.
From strategy to execution.
Yeah, all right, very well. Okay, so, yeah, I'm watching pretty closely right now BTC, which is now we're at 5 minute of a breakout over the 60,700 line, which is more bullish than it's bearish. Seems to be a little stuck in the mud right now. You've got Tesla has been stuck. And SPY in the Qs had a little run there, taking a slight little breather. What's going on with NVIDIA? NVIDIA's kind of barcoding, trying to find a direction, I suppose. Where's Meta? Let's get Meta up here. So we've been watching that one as well. Yeah, Meta actually keeps legging up. You know, when Meta does this, sometimes it's up like 5% on a day. I've seen that many times before. It makes me want to trade it, but I don't think I'm going to trade Meta. We'll see here. Apple. Meta just broke all-time high? Yeah, no kidding, huh? So, let's see here. Yeah, BTC topping it a little bit here. And Qs, oops. Qs, look at that. Rotated right back down. Then you've got Apple also rotating down. Tesla rotating down. NVIDIA. Okay. Let's see what happens. BTC suggesting the breakout, but it's giving up already. It is giving up, me friends. find the direction of the day after the data, and the barcoding's kind of a little wild. Okay, what else? Let's see what else is going on here. We got gold. Ooh, gold's actually down 1% today. 10-year treasury kind of normalized at about 6. And Tesla trying to stabilize here. Oh, Sarah's on. Let's go listen to Sarah. See what they have for the opening summary here. Powell's tomorrow, remember that.
Fed President Patrick Harker, as all the Fed presidents meet ahead of Fed Chair Powell's speech tomorrow from Jackson Hole. We've got a rally still, the S&P up 0.25% again. It's been a pretty strong week. 2 days of trading left, 1.5% gains for the S&P 500, almost 2% for the NASDAQ. Today, it's communication services in the lead. You've got names like Meta, Alphabet, all higher, some of the median names as well. Paramount, as David mentioned, technology, energy, financials, healthcare, consumer staples, all those groups in the green today. Materials and consumer discretionary and industrials are lagging. We're 30 minutes here into the trading session. Here are 3 big movers we're watching. Snowflake shares sliding despite posting a Q2 beat and a full year guidance hike. Analysts citing a deceleration in growth among the reasons for the stock's drop this morning. It's a steep one, 11.5% lower. Another name moving lower is Urban Outfitters, as same-store sales for Urban Outfitters brand fell 9.3% in the second quarter. And then also watch Peloton. Nice jump there after the company reported its first sales increase for the first time in 9 quarters. The stock is still down more than 40%, though, over the last full year of trading and way off of its pandemic highs.
Let's get some existing and head out to Diana Olick. Hey, Diana.
Hey, Carl, existing home sales in July broke a 4-month losing streak, rising 1.3% month to month to a seasonally adjusted annualized rate of 3.95 million units, right along expectations. Sales still down 2.5%, though, year over year. I would note these are closings, so sale contracts signed in May and June when mortgage rates were still over 7%. We're now down to around 6.5%. But the good news is that supply is rising. 1.33 million homes for sale at the end of the month. 0.8% month to month, but up a whopping 19.8% year over year. And that's probably why we're seeing more buyers come into the market. We're still at a 4-month supply, though, due to the higher sales pace. A 6-month supply is considered balanced between buyer and seller. And that low supply is still keeping the pressure on prices. The median price of a home sold in July was $442,600. That's up 4.2% year over year. But it is no longer the all-time high price, if that gives you anything. But it is still up year over year. We do have a lot of all-cash buyers in this market, though, 27%. That's up from a year ago. And the sales continue to happen on the higher end of the market. Sales of $1 million-plus homes up 26% year over year. And that's because the supply is up over 30% in that higher price range. Supply is down on the lower price range. And that's why sales are skewed toward the higher end. Sarah?
Yeah. Okay, Diana, thank you. Modest tick up there in Treasury yields on the back of that report. 10-year at 3.8%. Diana Olick, thank you. The other report to mention of the day was jobless claims. We get them every Thursday. Number of Americans filing for unemployment claims ticked up a little bit, but to 232,000, I mean, it's still low, and it speaks to a labor market.
Oh, it drives me nuts. No, Sarah, it doesn't speak to anything. It does not speak to anything. Please stop talking about unemployment claims. Oh, Sarah, I can't like you anymore. If you like unemployment claims as a leading indicator, I can't like you. It's the opposite of history. What is this? Fed Hawker. Lauren's texting me too. Okay, let me see what this Fed news is. Let me see here. Okay, Fed. Okay, what does Hawker have to say for us? Fed, Hawker. On board with September cut. Okay, let's write this down. Fed Hawker. I guess it's more like Harker. It sounds like there would be like a W in there, but it's Harker. Anyway, on board with September cut if data as expected. Slow, methodical approach. That's not good. Methodical approach to cuts is the way to go. Yeah, that's how you end up causing too much damage, and then all of a sudden you're like, just kidding, cut it to 0. That's not good. Okay, all right.
Nonetheless, maybe it is an indicator that we need more than just a single 25 basis point cut.
There's absolutely a case for a 50 basis point cut, particularly if you think
No, there's not.
July would have been the time to start with 25. Maybe you just got a little bit of a slow start. You can't entirely ding the Fed for information and data it did not have at the time. Particularly, I think these bigger, revisions looking backwards. The U.S. labor market had been slowing more than what had been thought over that entire time. And so that, recalibrating, right? So 50 basis point isn't necessarily a mistake. It's like we're going to recalibrate to get back on track. I think it's appropriate. I think the Fed, in terms of being so like every single data release was going to determine, as opposed to, hey, what's the direction we're traveling here? Like, where's the forecast? Like, I think they should have been cutting sooner. But, that's in the past.
But to the point that in July, you made this point online that several officials saw that case for cutting at that July meeting, and that meeting was 2 days before the July employment report. You also look at the minutes saying that a majority of participants had said the risk to the employment goal had increased. Also, again, before that latest employment report. So how much risk now is there, Claudia, to the job market, now that we know what we know now?
I think it's in this place of we're it is strong. I do not expect Jay Powell to say that again on Friday. The labor market is not strong. It is weakening. And then it is this question of the trade-off. Like, we are in a space of trade-off. Do you need this weakening to get inflation down? If you do, then that could be then you could still go forward with it, right? I mean, inflation is not back to target yet. Or if you're saying, no, this has gone too far. And honestly, the relevant jobs report for what the Fed does in September is not the next jobs report. It's the one we get 6 months from now. And so we don't get to have that one when they cut in September, right? They really have to forecast about the momentum where things are headed. And you don't, their mandate is maximum employment. It's not no recession. Right. So the bar here is to
and stable prices, right?
No less weakening in labor markets than is absolutely necessary to get inflation down. And I think the balance has now shifted. And I think we'll probably hear some of that from them. The balance is shifting towards we gotta shore up the employment mandate. It's going too far in terms of weakness.
And it's a great point, too, that it's not next month's jobs report. It's the one in 6 months that, we really care about. But if you think about the ones that we've had in the past couple of months and where we stand right now in the labor market, it just feels like there's a lot of different cross currents right now. Of course, you think about the tick up in prime age labor force participation. You think about the impact of immigration, what that means for the U.S. labor force. How are you weighing out those different factors, and where does that leave you on how strong this labor market actually is right now?
Right. So it is absolutely clear that one needs to pull on as many different possible angles of the labor market data. Like, the unemployment rate is not going to be sufficient. Payrolls are not enough. Employment, so really pulling all these pieces together. The stories are complicated. And for the Fed's decision making, they really are in a risk management stage. And then it's about telling the scenarios. Like, how could this go to a more negative scenario? How could this be, we just keep gradually moving along? Gradual rate cuts make sense, inflation, and then there are some inflation scenarios that one should be paying attention to as well. So it's a really complicated picture. I think that's one, it gives me pause when it gets tough to tell the story with the data. That is likely a time when things are shifting around under the surface, because if things were all moving in a very sensible way, all the indicators would kind of line up. So we are at a moment where the risks are elevated of pushing one way or the other, but we're not in a crisis scenario at the moment, that's very encouraging too.
Claudia, Mickey Bowman has pointed out that immigration has helped the labor pool grow, and that has brought down wage pressures. If we're already clamping down at the border more than we have been for the past 4 years, and President Trump wants to export 15 million illegal aliens who are also likely 15 million workers, right? If we get that immigration constrained, do we start to get wage pressures again, pushing on inflation?
Well, the labor supply story, there are a lot of pieces to it. Immigration is certainly an aspect of it. It takes some time for people coming into the country to fully integrate into the labor market. So it's not like this is going to turn on a dime in terms of our labor market. And it's also to remember as the economy has been strong, the labor market has been strong, we have seen prime age workforce participation hit all-time highs for some important groups like women, other minority groups. Like a really strong economy can bring people in. And if we are growing the economy because there's more workers, as they bring in the more supply, the Fed does not need to be afraid of a strong economy if it's because of supply. And there is a path to, this is not all just about immigrants bringing in supply. And so that's where keeping the economy going can actually keep that supply, bringing people in from the sidelines. So yes, yet it is a risk. The effects on immigration, and the immigrant workforce, because we did have a really big increase over a short period of time. That's tough to parse.
The other part of this is you really only have one Fed meeting before the November election. The next one comes days after the election. So either way you go, there are a lot of investors worried about inflationary pressures under either scenario. What tax credits could mean, for example, for the economy. At the end of the day, how much does the Fed have to caution to prepare from any future inflation that could be under the regimes of either future president?
Yeah, the Fed has enough on their hands right now trying to figure out the economy as it is and where it might be. I think Powell made pretty clear that they are not thinking ahead to outcomes of different policy. Like that's just not. There's too much to get ahead of. Absolutely, the Fed will respond as necessary to whatever policies come online in the coming years with a change in administration. But that's not. They just can't. It's unlikely, and I think it would be unwise to be trying to play that kind of three-dimensional chess right now when they have other issues.
Claudia, we got to leave it there. A lot of uncertainty ahead. That is chief economist at New Century Advisors, and of course, the woman behind the very highly watched Somm rule. Remember, tomorrow we're going to have special coverage of Fed Chair Jerome Powell's remarks. Our coverage begins at 9 a.m. New York time. And coming up, Vice Presidential nominee Tim Walz introduces himself to the nation. We're going to recap day 3 of the Democratic National Convention and look ahead to Kamala Harris's speech next. Plus, later in the hour.
No, thank you. We will. Kamala Harris's speech is today. I'll probably cover her speech. Let's listen over here for a moment.
But again, what matters is we start to bring rates down. That sets the expectation. Because this is all an expectation game, as you know, monetary policy. It's not about the rate today. It's about what the rate's going to be in the future.
Sure.
That's what matters the most, is that we commit to bringing them down.
And when you get to that point, well, first of all, are there lingering concerns about inflation given that you're still above target?
Yeah, it's interesting. So again, I've been out talking to contacts. Shelter, that's the big one that we continue to worry about. What I'm hearing from bankers is they're back in the mortgage business, right? They're now writing mortgages because, again, the longer end has come down. What we'll see, in my estimation, is the lock-in effect that we've seen with mortgages. As rates come down, people are going to start to move and free up some of the housing. Second, I've heard from bankers, developers, that they're sitting on projects and they're not willing to put a shovel in the ground yet until they start to see some sense that the rates are going to get back to where they can pencil it out. We're getting close to that point now. I think you're going to start to see some development. Now, this has not overcome the structural problems we have, whether zoning or you name it.
So you feel like reducing rates will bring more housing supply to the market, which will put downward pressure on housing inflation, which will put downward pressure on overall inflation.
At least that's the theory, Steve. I mean, we'll have to see how this plays out, but that's what we're hearing from contacts.
I'm sorry, but the inescapable conclusion is that you've been making inflation worse by keeping rates high.
Yeah, well, this is one where our understanding of monetary policy transmission,
which is what we're talking about here.
Yeah, the typical textbook model. Take rates up, things slow down, et cetera. There's a lot of nuance to that, and housing's a great example of that. We're going to learn a lot coming out of this this period in history
Right.
about monetary policy transmission. That's why this topic is so important.
Fascinating, Patrick. The idea that if you tighten into a housing shortage, you may make inflation worse.
Yeah,
Which is,
and again, the shortage was
Yeah.
here before the pandemic
Sure.
hit, right? So,
Sure. Real quick, we do have this, I guess it's a Canadian rail lockout.
Yeah.
We've just been through a period of supply shortages and then restoring supply. Are you worried again that you could get some inflation from the supply side?
yeah, potentially, just like we are with shipping, global
Sure.
shipping. So those things will affect the economy. But you know what's amazing if you step back, and I've been doing this now for almost 10 years, how resilient this economy is.
Right.
You know, these things hit us, but we react, we respond.
Let me ask you two really quick questions to close out here. What are the biggest risks that keep you up, that concern you?
One is just the geopolitical risks that we're facing. I mean, we don't know what's going to happen. There are lots of conflicts in the world. They can affect us pretty significantly. I worry about those. I worry about those not just from the point of view of the economy, but just the humanitarian issues.
And when it comes to the changing rates in September, are you concerned about the optics of that relative to the election?
No, in that I am very proud of being at the Fed, where we are proud technocrats. That's our job. Our job is to look at the data and respond appropriately. And I think when I look at the data as a proud technocrat, it's time to start bringing rates down.
Patrick, it's been a pleasure interviewing you today and over time here. Thanks so much, and we'll see you again soon. Carl, Sarah, back to you guys.
All right, Steve, thank you very much.
It's time to start bringing rates down. All right, very interesting. Yeah, let's see here. Wow, he said high interest rate debt just weakens growth and weakens borrowing, which weakens the dollar or some more inflation. I mean, that's, yeah, there's so many arguments in terms of what high rates can do. What you're referring to is this thing called inertial inflation, which is basically this idea that you're actually increasing costs at companies, so they have to drive their prices up more to cover their costs, which can create inflation due to higher interest rates. That isn't entirely certain, given that you can have the potential for essentially price limitations on what goods and service companies are able to provide. So anyway, I got to help Lauren with the kids, so we're going to push the button here. It does also look like the Q's potentially just hit a bottom. Let's go ahead and push the button, then we'll flip around here some of these pages. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Watch that right here to see if BTC gets rejected again at the 60,700. Okay, I gotta go help Jack. All right, we'll see you next time. Bye.